Hello, good afternoon, everybody. And my name is John Paul Ruiz, the Director of Professional Development here at the Entrust Group. And we welcome you to the national webinar, 3 Compelling Reasons Why People Choose an Individual K-Plan. One of the reasons why we wanted to develop this course is that we are coming up to the end of the calendar year, which is the fiscal tax year for most employers. And for those employers that are thinking about establishing an employer-sponsored plan for their business, this is a good time to start thinking about the individual 401k plan, which is one of 3 retirement plans for small businesses. The other 2 are your SEPs and Simples. But the focus of this course is on the individual 401k plan and why is it beneficial for an employer. Now, we're not going to go into too much great detail about the individual 401k plan, but we will highlight the characteristics of an individual 401k plan and focus on the 3 main benefits of an individual 401k plan in comparison to the other 2 employer-sponsored plans that are available for small businesses. Now, the seminar is intended to last approximately an hour long, with the last portion of the seminar devoted to answer any questions you may have in regards to the material presented. Now, if there is an influx of questions that may have come in based on the material presented and we are not able to answer all the questions, if you take a look at the bottom right-hand portion of the slides, it will say the # Ask Entrust. What we'd like for you to do is to tweet us in regards to any questions you may have that are not answered during this the Q&A portion of this particular seminar. Because we would really love to answer the questions that we can answer for you in regards to the material presented. Again, my name is John Paul Ruiz, the Director of Professional Development here at the Entrust Group. Now, before we get started, for those of you who are not familiar with the Entrust Group is a record keeper of retirement plans. Not only do we record keep the traditional mutual funds, stocks, bonds, which we are going to be launching within the next couple of months, our main specialty as a record keeper has been alternative investments. Therefore, I just want to provide a disclaimer that the Entrust Group does not provide investment advice nor endorse any investment products. We are not an investment provider. All we are is we allow an opportunity for employers as well as individuals who would like to avail of retirement products available out there by law, such as your individual 401k plan, SEP Simple, as well as your traditional IRAs, Roth IRAs. We provide the documents as well as record-keeping the investments. But as far as offering investments out there, we're not an investment provider. All the information and materials are purely for educational purposes only. Therefore, the information that we're providing is general information. We do not provide specific advice on specific situations for clients. We always refer them to a competent tax advisor or investment advisor. All parties are encouraged, again, to consult not only with their competent tax advisor or investment advisor, but also their attorneys and accountants or other experts that you may ask for advice from to advise you on a particular investment, such as whether or not to get into an investment or not, or are there any issues that you may need to be aware of. Again, we just provide general piece of information to help you get started, but ultimately you might want to seek out the advice of an investment professional and or legal professional or a tax professional in regards to addressing your specific situation. The Entrust Group, again, is an administrator or record keeper of self-directed retirement plans. Unlike, again, your traditional types or common types of investments found in retirement plans, we do specialize in alternative investments such as real estate, precious metals, notes, just to give you a few of the flavors of the alternative investments that we currently record keep in our portfolio. We are a leader in the industry. We've been around for over 30 years. We process over 12,000 to 16,000 client transactions every month, and we do administer over $2.2 billion of investor assets. And we've found that we've been pretty efficient in regards to the business model that we've created for our clients, and actually have tools to assist our clients to be able to manage their self-directed asset in their retirement plan. We have knowledgeable staff And we do own a school as well that we wrote that has been endorsed, that has been approved by the American Banking Association, primarily to train the industry experts in acquiring what we call the CISP designation, the Certified IRA Service Professional designation. We do have what we call our IRA Academy. So not only do we put our own staff through that IRA Academy to acquire the CISP designation, we also train other record keepers that desire to acquire that particular designation through the American Banking Association, American Banking Association's Institute of Certified Bankers. Our educators may provide national CE programs, continuing education programs for certain designations that they may have, such as real estate professionals, CPAs. Those could possibly qualify for that. CFP, Certified Financial Planners. We could either do our presentations, national presentations through the webinar. We can also do it in person in some locations where we get invited to present and use that general information as continuing education credits for those individuals who hold certain designations. One of the most recent designation that we have, or one of the most recent credentials that we have been approved for CE credits, is the enrolled agent through the IRS. So if you have IRS agents, enrolled agents that can be used by the IRS to perform certain tasks for them, enrolled, we have courses that could be approved by the IRS for their enrolled agents. And lastly, the Entrust Group has national offices. In other words, we have brick and mortar offices, or actually representatives in certain strategic parts of the country that may be able to help assist you in regards to the general questions you may have in entering into the self-directed retirement world. Well, enough said. Let's take a look at what the agenda is for today's course. Again, the main focus of this course is to talk about the individual 401k plan. And we're going to define what it is and demystify for you what is a thing called an individual K, or a solo K, or an owner-only 401k plan. Why is it beneficial for a self-employed individual or a business to set up an individual 401k plan? And answer the questions such as, me being the employer, do I qualify for an individual 401k plan? In other words, do I fit the criteria that would best suit an individual 401k plan? We'll talk about the eligibility requirements as well as the deadlines for an individual 401k plan, such as when does it have to be established, or when do contributions have to be made, as well as what type of contributions can be made. From there, we will focus on the 3 compelling reasons why employers choose an individual 401k plan. And hopefully, by presenting those 3 reasons, you'll be able to decide for yourself whether or not the individual 401k plan is best for you. Lastly, since we are a self-directed retirement plan provider, well, how do you invest in alternative investments using the Entrust Group by setting up an individual 401k plan once you find that it might be something that's for you? And last but not least, we will open up the phone lines for any questions you may have in regards to the material that is presented. Well, let's get started. What is an individual 401k plan? The individual 401k plan came about around 2002 with the passage of a law called EGTRA, the Economic Growth Tax Relief Reconciliation Act of 2001 under President Bush. There were changes in the law that dramatically affected retirement plans, not only in the IRA world, but also in the qualified retirement plan world. Whereas in the past, although it never prohibited a business owner who's an owner only, in other words, you don't have any employees, which most small businesses are, owner-only plans. In other words, they only employ themselves, their spouse, or maybe there's all owners. In other words, there's no rank-and-file employees. They have never been prohibited in establishing a 401k plan, but it was not practical to establish a 401k plan. Why is that? Because the contributions that may be used by an employer as a tax deduction was limited to 15% of their eligible compensation. Let me give you an example. Let's say an employer has $100,000 of income, and I'm just using $100,000 as a round figure. If you contribute to the plan, in other words, in a 401k plan, not only will you have an employer contribution, since it's a 401k plan, the individual can also defer a portion of their paycheck into the plan. Therefore, you have two components to it. One, the employee's contribution, and one, the employer's contribution. If you add the two together, the amount cannot exceed 15% of that employee's compensation, so that the employer can use that contribution as a tax deduction. In other words, the maximum amount for someone who made $100,000 is 15% or $15,000. That tells us that whatever the employee can contribute and whatever the employer can contribute cannot exceed that $15,000 figure. Well, what if an employer chooses to make a 15% profit-sharing contribution? What that tells us is that this individual will no longer be able to defer into the plan because they've used up that 15%. Therefore, for owner-only types of plans, it was not feasible to have a 401k plan because it was already used up by the employer's portion of their contribution. Now, most employers at that point, you don't have to remember this, but at least you know that there's a difference. Most employers at that point who wanted to be able to contribute more may pair that up with another plan called a money purchase pension plan. A money purchase pension plan has a mandatory contribution component to it. In other words, you have to make a contribution whether or not you made profit or no profit for the year. The reason why they would pair it up with that is because the deduction limit for a money purchase pension plan is up to 25% of compensation. In other words, it has a higher contribution limit. Now, why would they pair the two together? Because since it's mandatory, some employers would say, I would like a portion of my contribution not to be mandatory, but only use the mandatory portion to get me up to the 25%. Now, I'm going to stop there for a second. The significant thing that happened in 2001, which was effective in 2002, is that all retirement plans starting in 2002 will now be able to avail of the 25% deduction limit. In other words, you no longer have to pair your profit-sharing plan with a money purchase pension plan to get up to that 25% limit. In other words, for someone who makes $100,000, the employer can now make up to $25,000 as their contribution, up to 25%, and use it as a tax deduction, number one. The tax deduction limit went up to 25%. Another big change that Congress did at that point was that for the 25% amount, above and beyond that 25%, an employer could also defer into the plan. So not only can they make that $25,000 contribution, whatever the deferral limit is, in other words, the amount being taken out of a person's paycheck, can exceed that 25% up to the limit of that deferral amount for that particular year. In other words, if the deferral limit is $18,000, not only can you contribute $25,000 as a profit-sharing contribution, you can also defer up to $18,000. Thus, the contributions for these plans are higher than other retirement plans. Therefore, starting in 2002, organizations that as an example that I used to work for, came up with marketing terms, something that could identify this particular new feature. One of the companies that I used to work for came up with the term Individual K. Individual K means it's designed for businesses that only have owners that are participating in the plan, or in other words, owners that are the only ones that are eligible to participate in the plan. Small mom and pop shops. The IRS calls them as owner-only plans. In other words, you don't have any rank-and-file employees that are eligible to participate in the plan. And I'll explain what that means later on in this particular course. So in other words, if you have a husband and wife that opened up a business, and we'll take a look at the different types of businesses that are eligible to establish an individual 401k plan. And this husband and wife does not have any employees. They're the perfect fit or perfect target profile for an individual 401k plan. Why is that? Because unlike regular 401k plans, which an individual 401k plan is nothing more than a regular 401k plan, given the fact that if this business does not have many rank-and-file employees, businesses who do not have any employees do not have to run what we call the discrimination tests that are typically associated with 401k plans. If you don't have any employees, well then who would you discriminate against? Therefore, one of the features or one of the biggest benefits of not having any employees as a business is you don't have to run those non-discrimination tests, which sometimes would limit what the owners could actually put into the plan, because in these non-discrimination tests, whatever the level of contribution that the employees could make, as an example for the deferral, would limit the owner's maximum contribution to the plan. In an individual 401k plan, since it's only designed for businesses with no employees, well, then that test does not apply. Therefore, the individual 401k plan became a product feature, or a term that is used to identify businesses that can establish a 401k plan for the mere fact that they don't have any employees. With the increased contribution amounts, as well as which does not necessitate also the discrimination tests that are typically run in these types of plans, the 401k plan became feasible for small businesses. Now again, in the 401k plan, there are two components of contributions. One is the salary deferral component. In other words, a portion of a person's paycheck can be deferred into the plan. Also, the employer could also make a profit-sharing contribution that is between 0 and 25%. Where do we get the 25%? That's the maximum. In other words, the employer doesn't have to make a full 25% profit-sharing contribution. It can be between 0 and 25%. But for the most part, if you want to maximize your contribution, one of the biggest benefits of an individual 401k plan is that the contribution limit is up to 25% for the employer portion, and above and beyond that, the individual could also make a salary reduction agreement, in other words, deferring from their paycheck. Thus, therefore, the contribution amount that can be made into this plan is a lot larger than other types of plans. Now, who is eligible to establish a 401k plan? In this case, we're focusing on 401k plans because this is the focus of the course. Employers could also set up a SEP and a SIMPLE, but if you attend one of our courses describing a SEP and a SIMPLE, what you will find that the contribution amount that can be made by employers is much smaller than what you could make in comparison to an individual 401k plan. Well, in a nutshell, which employers are eligible to establish a 401k plan? Well, the answer is any employer. In other words, if you're a sole proprietor, in other words, you're a Schedule C filer, in other words, you file your tax return with your own personal tax return via what we call a profit and loss statement, Schedule C, you can have an individual 401k plan. Partnerships. The partnership can actually establish an individual 401k plan, and contributions can be made via what we call the earned income that is earned by one of the partners. That earned income that they earn cannot be passive income. It's earned income. In other words, the portion that they receive from that partnership as income that is subject to Social Security tax. And that's something that they might want to check with their competent tax advisor, because sometimes a partner may only receive all passive income. Therefore, they cannot defer into the plan because they don't have compensation that is considered earned income. However, partnerships can have an individual 401k plan. Limited liability companies or limited liability corporations. Limited liability companies, LLCs, may be viewed as a sole proprietor, or if there's two people, a partnership. And in some cases, the LLC may file for a special tax filing entity with the IRS, and the IRS would tax them as a corporation. Now, for eligibility requirements, corporations can also establish an individual K plan. Those are your S corps and C corps. Now, for S corps and C corps, one of the things you want to focus on if you're an S corp or a C corp is the only way you can actually contribute to the plan is if you have earned income again. From an IRS perspective, the only thing that the IRS defines as earned income from corporations is W-2 income. So if you don't have W-2 income and you have an S corp or a C corp, then that might be something you want to discuss with your tax advisor as well. Even though S corps receive what we call a K-1, the K-1 from an S corp is considered as passive income. Therefore, the IRS does not view that as earned income eligible for contribution to a plan. But again, who is eligible to establish an individual 401k plan? Any business. And we just talked about the different business types that are out there that are eligible to establish an individual 401k plan. Again, it's designed for businesses that are owner-only. In other words, there's no employees that are working for the business that are eligible to participate in the plan. And I'll define for you further what it means to be eligible to participate in the plan. Now keep in mind, eligibility requirements can be assigned to this plan to determine who can participate. Now, when we start taking a look at participation requirements to an individual K plan, not only does these participation requirements that an employer could assign in a particular document to determine who's eligible to participate, these eligibility requirements also apply to the owners themselves. The maximum requirement that an employer could impose on employees before they can participate in the plan is 1 year for the deferrals, as well as an age requirement of age 21. So therefore, if an employer wants to exclude individuals that are under the age of 21, as well as employees that have not worked for an employer for a period of 1 year, and that 1 year has a certain number of hours associated with it. The statutory safe harbor number of hours that define 1 year is 1,000 hours. Therefore, if somebody has worked for an employer for 1 year and has accumulated 1,000 hours and has reached the age requirement, the maximum age requirement of 21, they cannot be excluded from the plan, therefore prohibits an employer from establishing an individual 401k plan. They can still establish a 401k plan, but they will no longer be absolved of the non-discrimination tests, as well as their contributions may be limited based on the amount of contributions that are being made by rank and file employees. But if an employer has employees that have not met the age and service requirement, they can still establish an individual 401k plan, contribute to it, and not be subject to those discrimination tests. Now keep in mind again, as I mentioned earlier, the eligibility requirements that an employer may include or adopt in their document to establish the rules of an individual K plan not only applies to employees, but it also applies for themselves. And what do I mean by that? If an employer is a brand new employer and they put in an eligibility requirement of 1 year and age 21, given the fact that it's a brand new company, the employer may not have worked for that company for a year. Therefore, they themselves could possibly exclude themselves from participating in the 401k plan. So keep in mind, even though an employer may impose eligibility requirements, those eligibility requirements also apply to them when determining eligibility to participate in the plan. There are also employees that may be automatically excluded from participating in the plan. Those are what we call your statutory exclusions. And these are the two common ones that you will find under the Internal Revenue Code or the regulation, Treasury regulation. Those are your union employees covered by a collective bargaining agreement. What does that mean? If an employer employs union employees that they've already negotiated with a locale or an entity that is basically negotiating benefits, whether it be retirement, health, welfare benefits on behalf of the union members, and they are covered by an employer-sponsored plan under that union negotiated agreement, in other words, a collective bargaining agreement, Uncle Sam says you don't have to cover them under your individual 401k plan. Therefore, if you don't have any employees, then you can still have an individual 401k plan. Some employers may also employ non-resident aliens with U.S. earned income. If they're a non-resident alien with U.S. earned income, they need to be treated as regular employees. However, if an employer employs non-resident aliens with no U.S. earned income, those employees could be automatically excluded from participating in the plan. Therefore, the employer needs to consider whether or not they could still establish an individual 401k plan if all their employees are what we call non-resident alien employees with no U.S. earned income. Again, we're just giving you a high-level overview of the things that an employer would need to consider to determine whether or not they're eligible to establish an individual 401k plan. Another good reading for employers to vet out the best type of plan for themselves is the IRS Publication 560. The IRS Publication 560 is a free publication provided by the Internal Revenue Service that talks about the 3 different available plans out there for employers. And those are your SEP Simples, and in this case, the focus of this course, a 401k plan. It best talks about the features of the 3 different plans, and it's good reading for the employer so that as you consult with your tax advisor, your legal advisor, you'll hopefully be able to articulate the questions that you may have in regards to vetting out the best type of plan for you. The Department of Labor also has a brochure that can be accessed to have a side-by-side comparison that depicts the different characteristics with these different types of plans that are available for small businesses. But Publication 560 from the IRS is a good reading publication for employers who are contemplating whether or not they want to establish an employer-sponsored plan on behalf of their business. Again, as a recap, the different types of business entities, sole proprietors, partnerships, LLCs, which could be a sole proprietor partnership, as well as corporations, can establish an individual 401k plan as long as the business does not have any employees that are eligible to participate in the plan. And again, the eligibility requirements may have two components to it, one of which is an age requirement, and number two, a service requirement. The maximum service requirement, again, is 1 year for deferrals in an individual 401k plan, as well as the maximum age requirement can be a maximum of age 21. Now, when is the deadline to establish an individual 401k plan? One of the reasons why we're covering individual 401k plans right now is because it's a timely time of the year to determine whether or not you would like to establish an individual 401k plan for your fiscal tax year. The establishment of an individual 401k plan means that a document, or what we call an adoption agreement, to adopt an individual 401k plan for their fiscal tax year must be signed by the last day of their fiscal tax year. So in other words, if you have a calendar year plan, in other words, January 1st to December 31st fiscal tax year, then the document must be signed by December 31st. And that's, again, one of the reasons why we're talking about it right now, which gives you a few months to determine whether or not you want to have an individual 401k plan. If a document or adoption agreement is signed by December 31st of this particular calendar year and your fiscal tax year is December 31st, well then it's time to think about whether or not an individual 401k plan is right for you. Now, given the fact that there are employer contributions associated with an individual 401k plan, the deadline to make a contribution once the plan is established is by the employer's tax return due date plus extensions. Why is it the employer's tax return due date plus extensions? Because if an employer is going to make a profit-sharing contribution, which again, the maximum is up to 25% of all eligible employees' compensation, well, when does an employer determine whether or not they actually had profit for the year? Well, the IRS says by the time you file your taxes, and if you apply for an extension, because your tax return is complicated, I hope you would have determined whether or not you've made profit for that year. Once an employer determines what their profit is for the year, in an individual 401k plan, the contribution is discretionary. In other words, they can determine from year to year the amount that they would like to make as an employer contribution, called a profit-sharing contribution. That contribution must make it into the plan by the tax return due date plus extensions of the employer, or by the time you file your tax return, the IRS hopes that you would have determined whether or not you've actually made profit for that year. Now, given the fact that there's also the deferral component, the deferrals that are being taken out of an individual's paycheck, which, by the way, I mentioned earlier for S corporations and C corporations, the compensation earned by the employer or the owner must be what we call a W-2 wage. The amount being taken out of a person's paycheck must make it into the plan no later than 7 business days after the amount has been taken out of a person's paycheck. Again, if an employer is receiving a paycheck from the company, whether it be an S Corp, C Corp, if money is being taken out of their paycheck as a contribution to the plan, well, that must hit the plan no later than 7 business days after the amount has been taken out of their paycheck. Now, there are certain employers called Schedule C filers that do not receive a W-2. Why is that? Because they basically file a profit and loss statement. Their deferrals would be, the deadline for their deferrals would be at that point the tax return due date plus extensions that they would be associated in their filing for the actual business. In other words, the employer contribution as well as their deferrals can be made up until the tax return due date plus extensions of that sole proprietor. But if it's a W-2 wage, it has to make it into the plan no later than the 7th business day after the amount has been taken out of their paycheck. As a recap again, to establish a plan, the deadline is the end of the fiscal tax year of the employer. If it's a calendar fiscal tax year, then the document must be signed by December 31st of this year in order for them to have a 401k plan for 2015. The contributions, however, can be made up until the tax return due date plus extensions of the employer. Now, I'm giving you a lot of information here, and I hope you're writing copious notes. I don't expect you to remember all of it, but at least it's something that it's a starting point to ask your tax advisors. I like this individual 401k plan. This is my tax filing entity, and I know that I have to make a contribution by my tax return due date plus extensions. How do we go about doing that? Now, there are different tax return deadlines for the different types of businesses, and let me walk you through that really quick. If it's a corporation, the typical deadline for a corporation to file its return is March 15th. If a corporation files for an extension, they give them a 6-month extension, which makes the deadline September 15th. Partnerships have a tax filing due date of April 15th, typically tied to an individual's tax return due date. However, if a partnership applies for an extension, the IRS will give them a 5-month extension, which puts that ultimate deadline for the extension to September 15th. Lastly, sole proprietors file their profit and loss with their own tax return. Therefore, the individual's tax return due date of April 15th is the sole proprietor's tax return due date. And if they apply for an extension, they provide them a 6-month extension, which puts the ultimate deadline to October 15th. As you can see, there are different deadlines on when the employer contribution must be made. Once the plan is established by the end of the fiscal tax year and they decide to make a contribution, know that there are deadlines on when that contribution has to be made into the plan in order for the employer to use that contribution as a tax deduction. Now, here are the 3 compelling reasons which we've been reiterating or been talking about throughout this particular seminar that makes an individual 401k plan attractive for employers that want to maximize the contributions that can be made into these tax-deferred accounts. Number 1, the contribution that is made by an employer is used by an employer as a tax deduction. In other words, those amounts may reduce the taxable income that they have as an employer, as well as those assets will continue to grow tax-deferred under these particular retirement plans until they take it out. There are also features under an individual 401k plan that allows for the owners to make what we call a designated Roth contribution. The designated Roth contribution, unlike a regular pre-tax deferral into the plan, has a special benefit upon distribution. Designated Roth accounts are contributions that are made on an after-tax basis. In other words, the contribution that is made to this plan by the employer will have been viewed as having been taxed already. What does that mean? Those assets must be tracked separately. Why? Because the contributions would have already been viewed as taxed already. Now, what's the benefit of that? The benefit of that is not only will that account grow tax-deferred, but may also be distributed tax-free later on. Now, how is that distributed tax-free? If an employer has had the designated Roth account for 5 years and has satisfied one of the 3, in other words, these 2 sets of criteria must be satisfied. Number 1, they must have had a designated Roth account for 5 years, as well as one of the 3. If they die, turn age 59 and a half, or become disabled, all the earnings on the contributions called deferrals, in other words, the amount being taken out of a person's paycheck, all the earnings will be tax-free. Now, again, there are 2 components of contributions that can be made by an employer in an individual 401k plan. One is an employee contribution called a deferral. The maximum for that is $18,000 for an individual who is under the age of 50. Once a person maximizes that $18,000 and they are age 50 and over, in other words, if you're 49 and you're going to turn 50 by the end of this year, in other words, you're going to have a birthday, you are already eligible for an additional contribution called a catch-up contribution. So not only can the employer defer $18,000 into the plan, they can also make an additional $6,000 called a catch-up contribution. Above and beyond that, the employer can also make what we call a profit-sharing contribution. Profit-sharing contribution maximum, again, is up to 25% of an individual's compensation. Now, there is a cap to it, however. So therefore, the rules actually say the maximum profit-sharing contribution is the lesser of 25% of the individual's income not to exceed $53,000 for 2015. Stop there for a second again. The maximum, again, is up to 25% of an individual's income not to exceed $53,000. Now, keep in mind, when we take a look at the $53,000, that encompasses all the employer contributions and deferrals that are not considered catch-up contributions in determining the maximum cap of $53,000. So for someone who makes $100,000 for the year, not only can they make a $25,000 profit-sharing contribution, or 25%, they can also defer up to $18,000 above and beyond the $25,000, which puts us at $38,000. And if the person is age 50, they can also put in an additional $6,000. Now, all these contributions that we're talking about, excluding the $6,000, cannot exceed $53,000. Now, when would we exceed $53,000? What if somebody makes $400,000 for the year? If somebody makes $400,000 for the year, you can't make a 25% of the $400,000 for the year as a contribution. That's where the $53,000 caps that employer contribution, right? So again, this is something. This is just a high-level overview of the rules, but it is still good for the employer to check with their tax advisor or legal advisor to determine, number one, how much are they projected to make for the year, and number two, are they trying to maximize their contribution? And if they are, an individual 401k plan might be something that they may want to consider in establishing before the end of the year, if you don't have one already, to contribute to by their tax return due date plus extensions, depending upon, again, the type of employer that they are as an entity, to determine when they can actually make a contribution to the plan. Another compelling reason, another reason why employers may want to establish an individual 401k plan is because, unlike IRAs, in a 401k plan, you can actually borrow from your own account. You can borrow up to 50% of your vested balance. In other words, if you have $100,000, you can borrow up to $50,000. There's a dollar cap to it as well, and that's $50,000. You can borrow up to that amount as long as you pay yourself back. In other words, pay your account back, pay the plan back, with an amortization schedule that does not go beyond 5 years, and it has to be paid back at least on a quarterly basis, using a reasonable rate of return. What's reasonable? A reasonable rate of return, as an example, may be the prime rate plus 1 or prime rate plus 2. Anything that's commensurate to whatever a consumer loan may be outside of your 401k plan would be a reasonable rate, but that's just an example of what most employers would use. Prime plus 1, prime plus 2. This loan is non-taxable unless the employer decides not to pay themselves back, which is a violation of that particular arrangement. The employer must make a payment on a quarterly basis, and if they miss a payment on a quarterly basis, they have until the end of the following quarter to make up that payment that was missed in order for them not to be in violation of their loan agreement with the plan. If they're in violation with their loan agreement with the plan, it may be a plan operational issue. Also, the amount of the loan will be fully taxable at that time that they miss or violate or not make a payment towards the loan that they borrowed from the plan. But for all intents and purposes, loans are available in a 401k plan since there is a prohibited transaction exemption allowed by the Department of Labor for these plans to allow for participants to borrow from their own account in a 401k plan, whereas in an IRA, like your SEP IRA or your simple IRA, loans are not allowed. Again, the three main features that are different in a 401k plan in comparison to some of the employer-sponsored plans. Number one, there are larger contributions. In a 401k plan, an employee can defer up to $18,000, and if they're age 50 and over, they can make an additional $6,000. The employer themselves, of course, assuming that their compensation would support and they could afford it, they can contribute to 25%, not to exceed $53,000, as a profit-sharing contribution to the plan. And last but not least, in an individual 401k plan, a participant can actually borrow from their own account as long as they pay them back on a quarterly basis within 5 years using the reasonable rate of return. These are the three differences, distinct differences of an individual 401k plan in comparison to a SEP plan and or a simple IRA plan. Now, here are the other advantages in an individual 401k plan which may not be available in the Entrust individual 401k document. Again, this educational piece is purely to talk about the individual 401k plan. There may be some restrictions in the Entrust product because we're not just selling our product. We're trying to educate you on the general rules in regards to the individual 401k plan. In an individual 401k plan, which is called a qualified retirement plan, contribution can be made in cash or property. In some plans, contributions are made in the form of employer stock to raise capital for the company. Employer stock is allowed under a qualified retirement plan. In some cases, an employer may also buy a piece of property using plan assets, and if there are no other pieces of property where the employer could actually lease from, they could actually lease from that particular piece of property as long as it doesn't lease more than 25% of that property to be able to run the actual plan. In some places, an employer may not have another place to lease for their business, and they may be able to lease a piece of property that is owned by the plan. The Department of Labor has allowed that in the past. Now, if an employer would really want to get reliance and an okay from the Department of Labor, it is highly recommended that the employer apply for what we call an advisory opinion and tell the Department of Labor that you've allowed this for other plans. I'm applying for one for myself. It doesn't cost the employer anything, but it's nice to have that piece of paper from the Department of Labor. In the individual 401k plan, which is also found in the Entrust individual 401k plan, it's what we call a self-trustee plan. The trustee can choose the plethora of investments out there that are available to be held under their plan. Therefore, they also manage the checking account, or in other words, the cash portion, the cash ownership of the individual 401k plan. They would have to establish a checkbook underneath the name and tax identification number of the plan. And yes, the plan may be required to get a tax identification number, given the fact that individual 401k plans may have to file what we call an IRS Form 5500 once the assets reach a certain threshold, and that threshold is $250,000. Therefore, using that tax identification number of the plan, the trustee or the employer may establish a checkbook on behalf of the plan. So in other words, if the plan wants to buy pieces of real estate, then that checkbook can be cut from that checking account under the plan to purchase a piece of real estate, and that piece of real estate must be titled or vested under the name of the plan because it's a plan asset. For individual 401k plans, as an advantage for some it may not be, they are also allowed to hold life insurance contracts. Now, it's not always an advantage if you understand how this particular situation works. Holding life insurance contracts may be detrimental for an employer as well, but it's good to talk about in this particular session. If you hold a life insurance contract in your 401k plan, the benefactor of that life insurance contract is the plan. Therefore, if a person dies, although you're receiving that benefit on behalf of the life insurance contract as protection, so that in the event you die, a certain amount would go into towards your beneficiaries, the benefactor of the life insurance contract is the plan. Now, if you understand how life insurance contracts work, life insurance contract payments to benefactors is tax-free typically. However, if a plan holds life insurance, the life insurance proceeds of that contract will be made payable to the plan. And once the plan distributes the proceeds to the beneficiaries upon the death of the individual, the assets will be taxable. So in some cases, although it may be advantageous from a payment of premium perspective, it might be disadvantageous for tax purposes on behalf of the beneficiaries. But again, it's something that we should talk about, that life insurance contracts can be held under a 401k plan. There are also certain situations where an employer may want to borrow money. Not the employer, but the plan may want to borrow money called a non-recourse loan to purchase a particular investment. In other words, you want to buy a piece of property that's $200,000. Your account in the 401k plan is only $100,000. it is actually allowed for the plan to borrow that extra 100 via what we call a non-recourse loan. In other words, if you defunct on the loan, then the lender can only go back after the assets within the plan. That relationship is what we call unrelated debt finance investment relationship under Publication 598, which can be good reading for you if you want to do something like that. Publication 598 talks about unrelated debt finance investment under a retirement plan. Individual 401k plans are not subject to unrelated debt finance investment. Therefore, there is no taxation on the income that is associated with the portion that was borrowed to purchase a particular investment property. Individual 401k plans under Section 514C is carved out from unrelated debt finance investment, unlike individual retirement arrangements. Now, when we start taking a look at investing in real estate under your 401k plan, which is basically our niche, now we're talking about our product. If you want to invest in real estate under an individual 401k plan offered under the Entrust Group, pretty simple. Find the property you want to purchase, make an offer in the name of the plan, of course, cut the check to the title company or whoever it is that the plan is purchasing from, and the vesting or the titling of the piece of real estate to the recorder's office must be the Entrust Group for the benefit of the individual participant and the trustee's name for the plan. In other words, the name of the plan. Then the escrow is funded by the plan trustee via what we call a checkbook, again, under the name of the plan. Closing documents, again, must reflect the beneficial interest of the plan, not those of the individual. And the fund amount is wired by the trustee to the escrow company, or a check is just cut at that point. Many different ways because the property could be purchased at an auction as well. So it's fairly simple. Now keep in mind, in order for you to do this, you must establish your individual 401k plan by the specific deadlines before purchasing the property. You can't buy the property and then put the property into the plan. The property must be purchased using the retirement plan assets. Again, to get started, open an account with the Entrust Group, fund your account. How you fund your account? How do you fund the 401k plan? Whether it be via contribution, or if you have IRAs or other 401k plans from previous employers, those can either be rolled over into the individual 401k plan, or if you have an existing 401k plan at a different provider and you want to move it to Entrust, we can just transfer those assets over to the Entrust Group to fund your account. From there, you're ready to purchase. Set up an account, checking account under the name and tax identification number of the plan, and voila. The employer can actually purchase that asset, and of course the Entrust Group will be playing the record keeper on behalf of the employer, making sure that the account is titled under the plan, et cetera, et cetera. Now, in summary, we've defined for you what is an individual 401k plan. It's not any different than any other 401k plan. It just so happens that it is designed specifically for employers who do not have employees. That makes it feasible for these types of employers to have a 401k plan. Eligibility requirements can be imposed on behalf of employees, but it also applies to the owners themselves. The deadline to establish an individual 401k plan, again, is by the end of the fiscal tax year of the employer. And if they're a calendar year plan, it's December 31st. Contributions must be made by the employer's tax return due date plus extensions. Again, if it's a corporation, March 15th with a September 15th extension deadline. Partnerships have April 15th with an extension deadline of September 15th. And last but not least, sole proprietors, Schedule C filers have a tax return due date of April 15th with a 6-month extension, putting it at October 15th. Last but not least, the main three differences of an individual 401k plan to other types of employer-sponsored plans is that the deferral limit is much higher in an individual 401k plan. The employer can also make a larger profit-sharing contribution, mainly up to 25% of each eligible employee's compensation, as well as individual 401k plans have a loan feature. In other words, the participant can actually borrow from their account. And last but not least, we talked about how to invest in real estate or other types of alternative investments using the Entrust Group's platform as a record keeper. Now I've talked quite a bit, and now we're going to open up the phone lines for any questions you may have. Now, the first question that I have is the plan insured by FDIC. That's a pretty good question. Now, alternative investments are not under a bank or other financial institutions covered by the Federal Deposit Insurance Corporation. If there is an account under a bank account under an individual 401k plan, only that portion will be covered under the FDIC rules. The coverage of that in the event that the bank becomes insolvent is up to $250,000 for that particular account. Given the fact that this is an owner-only plan, that $250,000 will aggregate, in other words, will combine within that bank IRAs that are held by the taxpayer. So if the taxpayer has an IRA at that financial institution and they also have an individual 401k plan, it may be viewed as what we call those old TO accounts or HR10 plans. Those two balances will be aggregated together, and the coverage of $250 is based out on the balance of those two accounts. Now, if an employer holds a piece of real estate, that is not covered under FDIC because it's not a deposit account under the bank. So therefore, for FDIC coverage, it's only accounts held under the plan that may have FDIC coverage. All right. Now, if there are any other questions, I would love to answer any questions you may have in regards to the material presented. I believe there's another question. Here we go. In addition, I wish to borrow funds from the solo 401k plan to buy rental properties and hold within the account or borrow as repair funds for future flips. Now, when you start taking a look at an individual 401k plan, there is no need to borrow from your individual 401k plan. If the individual 401k plan is funded and fully funded, in other words, there's enough money in there to purchase a piece of real estate, all the buying and selling can be done under the 401k plan. You don't have to borrow and take the money out and buy the piece of property outside. It can be done all under the umbrella of the individual 401k plan. Now, cash that is received from, as an example, rental of a piece of real estate held under an individual 401k plan, number one, is non-taxable while it's sitting under a retirement plan, because under Section Publication 598, there are certain incomes for certain investments that are non-taxable, called passive income, that is earned by a revenue-producing type of investment under an individual 401k plan. And number two, when a property is sold under the umbrella of the individual 401k plan, there's no capital gains on the investment. Why is that? Because the gains on that will be taxed upon distribution of the property. So if you were going to buy and flip houses, I would do it under the umbrella of a retirement plan. I wouldn't borrow from it and purchase the piece of property outside of a 401k plan. So I hope I understood your question correctly, but if you want to buy a piece of real estate, do it under your 401k plan, under your account, and it can be purchased, bought, and sold, flipped. And if you want to revitalize the piece of property, that's when hopefully you have enough cash within the plan that could be used or utilized to for example, fix the roof of the house, repairs. All of those have to be assets within the plan. Payment of expenses also have to be within assets within the plan. In other words, paying property taxes, homeowners association dues, those all have to be paid under the plan. In other words, you're running pretty much a rental property under your retirement plan. So to answer your question, somebody would like to buy rental properties under an individual 401k plan? Sure you can. Sure you can. Can you borrow from the 401k plan? Sure you can. You can borrow them, but it's not advisable to borrow from your 401k plan. Why is that? Although it's a feature, you have to pay yourself back, number one. When you're paying yourself back, you also have to pay yourself back with interest. The interest that you're paying yourself back with are dollars that have been taxed already, similar to paying for any type of loan. That interest that you pay yourself, when you distribute it, it's going to get taxed again. So in some cases, borrowing, although it's a feature for the plan, it may not be advisable to borrow from the 401k plan. But if you want to buy a piece of real estate under your 401k plan, you may do that. You may do that. Here's another question I may have. I have not yet established a business, but intend to earn income via real estate flips, in addition to a direct marketing business. I have one brokered IRA and a 401k from a former employer. I'd like to roll into a solo 401k plan as my first contribution. Is this allowable? Yeah. The question is, if you establish a 401k plan, can you fund it via rollover from an IRA and or a 401k plan from a previous employer? Yes, you may. This is what we call a direct rollover. That rollover, that amount that you put into the plan will be kept tracked separately as what we call a rollover source inside your 401k plan. And the reason why we call it a source is because there are certain sources of contribution. You have your deferrals, you have your profit sharing contributions, and you also have, in this case, a rollover. If you want to roll over assets into the plan, you can definitely do that. The reason why we keep track of these accounts differently is because to have access to these accounts, keep in mind again, this is a regular 401k plan. In a 401k plan, the moment you put money in, you can't just take your money out. I don't know if you've noticed, if you've ever worked for an employer that has a 401k plan, if you ask for your money, the employer would say you can't have it because you haven't reached normal retirement age, or maybe you haven't quit, you haven't died, you haven't become disabled. You don't want to die, but you could. You're not disabled, or the plan has not terminated. In other words, they're what we call triggering events to access certain dollars. Rollover dollars into a 401k plan, in most cases, do not have a trigger. So you put money into a 401k plan via rollover, you can access your rollover dollars at any time because those are assets that's yours. You're just rolling it over into the plan. Therefore, us as a record keeper will keep track of those rollover dollars separately. So that tells us that you might not have access to your deferrals. You may not have access as a distribution to your profit sharing portion, but you may have access to your rollovers. I gave you more of a longer answer than you asked, but I wanted you to be able to see the full gamut of the response. So, in a nutshell, can you fund your 401k plan via rollover from other established retirement plans? The answer is yes. You can do a direct rollover from your IRA into a 401k plan as long as it's not a Roth, as well as you can also roll over a previous employer's 401k balance that you have into your individual 401k plan, as long as you have a viable business, of course. Again, I'm trying to answer as many questions as presented to us. But keep in mind, again, when time is up, and if you shut down the seminar, please take a look at the bottom right-hand corner of your slide and tweet us that question, and we'll be more than happy to answer that question for you, even if it's after the seminar deadline. Here's another question. In a self-directed retirement plan, may the individual buy a property using an AITD purchase? I'm not quite too familiar with an AITD is. Plan assets would cover all the costs of the purchase, but they are assuming an original owner present loan, but it is not ever in the buyer's name. If you're talking about an ulterior ego that is controlled by in other words, you're loading your plan personally, assets that's owned by you, even though it's not under your name, you control it. It may be considered what we call a potential prohibited transaction. If I'm reading into the question, all right. It is best that if you want to if you want your plan to borrow money to purchase another piece of real estate and you don't have enough money in it, I would highly recommend that you don't want to have it come from you. It's highly recommended that you have it come from a non-recourse loan provider. And the Entrust Group will be more than happy to give you a long list of them, and it's up to you to vet it out. And the reason why I'm saying that is because it's not good to dabble with transactions that could cause what we call a prohibited transaction, because there's, number one, an initial penalty of 15% if it is, in the event of an audit, discovered. And number two, if it's not corrected in a timely fashion, in other words, within 1 year, in other words, by the end of the next plan year, then the penalty goes up to 100%. So if you really want to borrow money, I would highly recommend, of course, with the approval and advice from your tax advisor, legal advisor, it is best to go ahead and have an arm's length transaction and borrow from another entity. Your plan borrow from another entity. There are non-recourse loan providers out there that are arm's length, so that it doesn't cross the line of a prohibited transaction. All right. Can one LLC hold more than one real estate IRA rental? Can one LLC hold more than? Absolutely. And I guess my question is, where does the LLC come into play when it comes to the individual 401k plan? Because in an individual 401k plan, it is already a trust. Will the 401k plan purchase interest in an LLC that's an arm's length transaction? Or is the 401k plan buying the real estate directly? If you have a 401k plan, there is no point in having an LLC because there's already checkbook control in the 401k plan to purchase the pieces of real estate directly from the plan. All right. So if that's so to answer your question, can an LLC hold more than one real estate? Sure, it can. But if the business is what we call an operating business, the pieces of real estate that is being purchased hopefully isn't being purchased from a disqualified person, such as the plan provider. So in other words, you might dabble in prohibited transactions again. But again, if you don't want to set up an LLC and you just want to buy the pieces of real estate directly and held under the individual 401k plan trust, well then it can be purchased directly and be titled under the plan without having an LLC in place for that. If you want to discuss that further, I'd be more than happy to have one of our competent business development managers to have a discussion with you in regards to that. Not to advise, but again, to talk about general piece of information. Another question is, the funds borrowed to flip would be returned to the account upon the sale of the home and pay back the loan. If I'm understanding the question correctly, you have a plan that wants to buy a $200,000 piece of property, and you have $100,000 in the plan, and you find a non-recourse loan provider for the extra $100,000. All right, properties purchased using plan assets, remodeled, sold. Where does the money go back to? Well, it has to go back into the plan because technically the individual doesn't own the property; it's the plan that owns the property. As the money comes back, then at that point, the non-recourse loan lender would be the one paid from the proceeds of the sale of the house. So in other words, if the statement, the funds borrowed to flip would be returned to the account upon sale of the home and pay back the loan, that is absolutely correct. That's absolutely correct. It is all done under the umbrella of the plan as an arm's length transaction by the participant in the plan. I've not filed 2014 taxes. Can you establish an account for 2014? The answer is no. However, there is another plan called a SEP plan. Although this is not the focus of the course, I just wanted to let you know it's not the end of the world. A SEP plan can be established up until the tax return due date plus extensions of an employer, and you can make a contribution up to 25% of your income for that year, of course with certain adjustments if you're a Schedule C filer, and establish a plan for 2014. However, if you want to establish a plan for 2014 called an individual 401k plan, unfortunately it's too late. But again, if you want to make a contribution for 2014, you're still eligible to make a SEP contribution for 2014, establish and fund the plan by the time you file your tax return. So for all intents and purposes, employer-sponsored plan, you still have SEP as an eligible plan for 2014. If you want to establish an individual 401k plan for 2015, then sign a document by the end of this year. But to answer your question, no on the individual 401k plan, but you can on a SEP plan. Here's another question. Employee family members, what familial relationship are accepted to keep it as owner only? Account holder, in other words, the owner, husband and wife. If you have a son or a daughter, then they could be considered what we call rank and file employees. Therefore, you may not have an individual 401k plan. Then you might want to consider a SEP or a SEMPL if you have family members. But it's typically the owners only and their spouses. So if you have two partners and their spouses work for the company as well, then those are the only ones that those are the only family members that can be considered to still remain eligible for an individual 401k plan. I hope that answers your question. What is the cost to transfer a current 401k plan into a real estate investing account? I'm gonna not answer that question on the phone. I would highly recommend to contact Entrust Group's, one of Entrust Group's business development managers, and they'll be more than happy to talk about our fees with you. At that point, love to have you be a client of Entrust, and because there are different pricing models on the different types of investments that you may choose, and barring, of course, broadcasting it out there in the world, it's nice to have a one-on-one conversation with one of our business development managers. Please call us at 1-800-392-9653 so that one of our business development reps can talk about our fees with you. What happens to my IRA investment if the Entrust Group becomes insolvent? All right. If the Entrust Group becomes insolvent, any accounts that are held under a bank, for example, a non-interest-bearing checking account, may have what we call FDIC coverage. But in any sort of speculative investing, such as a broker-dealer like TD Ameritrade, E-Trade, Scottrade, or any other financial institution that has assets that are not held under a bank, most of those assets, stocks, bonds, mutual funds, there's typically no coverage under that. So therefore, if we become insolvent, typically what will happen with the assets is because it's going to go under receivership, and then your assets in turn will be either transferred to another custodian, because if it's real estate, it doesn't go away, right? So the piece of property may be transferred to another custodian, and or if you choose to decide to sell the property, and then that amount may be distributed to you. That's one of the biggest benefits of having an alternative investment, such as a piece of real estate. The real estate doesn't go away. When the market crashed, your stocks, bonds, mutual funds, it could be that your asset, which is basically a hypothetical unit held by a money manager, could essentially disappear. Why is that? Because it might be worthless. When you have a piece of real estate, the piece of real estate could deflate in value, but the piece of real estate is still there. So I hope that answers your question. So I've been around for 30 years, so being insolvent, there's not a big chance for that. But it could be possible, but most of the time what happens is the assets that are under our custody will in turn go under receivership, and then somebody would probably take over that account, and those assets will be transferred to another custodian. What are some of the marketing plans that have been most successful? I don't quite understand that question. If you want to further elaborate that, I would love to chat with you in regards to chatting with you about what marketing plans you may be speaking about. We can go offline and talk about that. Could I roll a SEP IRA into an individual 401k plan? The answer is yes. A SEP IRA is nothing more than a traditional IRA that receives a SEP contribution. Once the SEP IRA receives the SEP contribution, then those assets become regular traditional IRA assets, and traditional IRA assets that are called pre-tax. In other words, amounts that have not been taxed before. And hopefully the taxpayer has been keeping track of assets that have been taxed already, called non-deductible contributions. And those are tracked using what we call an IRS Form 8606. In other words, if somebody has $100,000 in their IRA, SEP IRA, simple IRAs, traditional IRAs, $100,000, it just so happens that in the traditional IRA they've made $10,000 worth of contributions called non-deductible contributions. In other words, dollars that have been taxed already. What that tells us is that only the portion above the $10,000 can be rolled into an individual 401k plan. So it's best to talk to a tax advisor what that amount is. But to answer your question, can a SEP IRA be rolled into an individual 401k plan? The answer is absolutely, but only pre-tax portion, right? And again, how you figure that out is by what we call the IRS Form 8606. Now the question, is there someone at Entrust to walk a person through the 60 pages of the application for a solo K? Absolutely. Most of the pages of the 60 pages is what we call the basic plan document. What we hold is what we call a prototype document that has gone through the IRS approval. And one of the documents we will provide you if you establish an individual 401k plan with the Entrust Group is that you will receive two sets of documents. One set is the opinion letter that tells you that this has been approved by the Internal Revenue Service and number 2, the basic plan document in one packet. The basic plan document is what we call the basic rule book. That is how, it contains language provided by the IRS called listings of required modifications. That's just a rule book. There's nothing that needs to be filled out from there. The other set of documents is what we call our service agreement, of course, to make sure that we get paid for the services that we perform, as well as what we call the adoption agreement. The adoption agreement is what the employer completes to establish the individual 401k plan. And as I've walked quite a few clients through that document, and it typically takes about 10 to 15 minutes, and it's only about a few pages long. So you take a look at the 60-page document. That's basically what we call the basic plan document. The adoption agreement basically pulls from that basic plan document the provisions that establishes the individual K plan for the employer. That's only about 5 pages long. So don't get intimidated by the packet. We have to provide it for you because it's part of the complete gamut. To answer your question, do we have someone at the Entrust Group that can walk a person through the 60 pages? The answer is absolutely, we do. What professional types have been most responsive to starting a 401k plan, and what types of ads have been used? Now, keep in mind, this is a marketing thing. Again, I'd be more than happy to go offline with you in regards to that, but since this is more from a consumer type of a seminar, this is a marketing thing. I'd like to chat with you or somebody from our business development group to chat. It appears to be that you're a person that would like to offer 401k plans out there in the industry. Would love to, again, go offline and chat with you on that. We're trying to focus on specific questions in regards to the individual 401k plan and or the Entrust products. Again, if you have any questions, any other questions, I'd be more than happy to answer those questions for you. I'll wait for another 30 seconds or so. Again, if you have questions that may come up, you may have catharsis in the middle of the evening, you say, I forgot to ask that question, please call us at the 800 number or tweet us at #AskEntrust, and I'll be more than happy to answer any questions you may have in regards to the materials presented. Well, if there are no more questions in regards to the material presented, again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. If you have any further questions in regards to the material presented, or if you want to hop on the phone with your tax advisor and or legal advisor to ask about general questions, we'd be more than happy to sit down with you and chat about general piece of information so that you can make an informed decision before you establish a specific type of retirement plan through the Entrust Group. Again, we thank you for attending this seminar, and we look forward to having you again at another Entrust Group National Webinar. Thank you, and have a great day.